sell more than you can cope with, that means you have to store them somewhere, and that means there's extra costs involved. You have to take that into account as well. Or it may be you take on temporary staff for that 1 month. There's an extra cost involved in wages. If you're forecasting sales higher than you can actually produce, you have to look at the costs involved in it as well. And that's sales forecasting. In terms of what you're spending your money on, that again will depend on your particular type of business. But that's just a general guide to some of the things that are likely to be involved. Some of these are one-off startup costs. Tools, vehicles. We're not going to be spending money buying them every month. They're one-off things that will last for a long time. Some of these things are regular monthly costs that you'll be paying. And you've got to work out what are the running costs in my business, what are the startup costs that I've got to buy something to last me several years, and what ones are going to be incurring on a regular basis. There's generally 3 types of cost in business. There's running costs, fixed running costs, and variable running costs. If you think about it, there's no such thing as a fixed cost. Costs do change over time. But what accountants mean here is variable running costs vary with the volume of business. Fixed running costs do not. So take an example of that, the cafeteria. If you go to the cash and carry to restock, what you're buying depends on what you sold last week. That's a variable cost. It will change with the volume of business. But the rent you're paying for the premises is fixed. It's not fixed forever. We'll have to renegotiate it one day. But in terms of number of customers coming through the door, it doesn't matter if you get 1 customer a week or 1,000. The rent stays the same. So you've got some costs that will vary with volume of business, variable costs. And you've got some costs that are independent of volume of business, fixed costs. You've also got capital costs. These are the things I said, you buy them once and they last you for several years. So you don't have regular spending on these things. And you've got to decide which costs fall into which category. Basically, capital costs, you're buying machines or tools or computers to help you run your business. You're not going to be selling these off. You're going to buy them so that they help your business. And they're going to last you for several years. And it would be wrong, therefore, to charge the cost of these against one particular trading year, because they're going to last you for several years. And accountants came up with this thing called depreciation, which is basically saying, what does something cost us? How long is it going to last us for? Let's spread the cost in terms of expenses to the profit and loss account. Let's spread the cost over the life. So if you buy a car and it's going to last you for 4 years and you're going to be using it in the business, it might cost you £12,000. You've got to find the finance to get that car in the first place. But in terms of treating it as an expense against your business, it would be wrong to say it's £12,000 in 1 year and nothing in the next 3. It's really £3,000 a year spread over 4 years. And that's basically what depreciation is. For capital items that are going to last you, you take the cost, you take the life expectancy, and you spread the cost in terms of profit and loss accounting over the life. And it's important you understand the difference in your business. What's a capital cost? What's a fixed running cost? What's a variable cost? So here's just a wee example. A building company, a business in the construction industry. That's a list of some of the costs they're going to have. What I want you to do is just shout out, is it a fixed running cost, is it a variable running cost, or is it a capital cost? Office, rent and rates. Fixed. You're paying the same amount to the landlord every month, regardless of how busy you are. That's the fixed running cost. Sand and cement? That's the materials you use. So the busier you are, the more you will use them. It's a variable cost. Company vehicles? That's a capital cost because you're spreading it over the life of the business. It's dead easy, this stuff, isn't it? No, it's not, guys. This is accountancy. What happens Company vehicles, you don't actually buy them, you lease them. A lot of businesses do that nowadays. They don't buy vehicles, they lease them for a few years and then they go away and they get another one. So if it was a leased vehicle, what would it be? It wouldn't be a capital cost because you're not buying it. It would be a fixed, it would be variable. Difference of opinions here. And you're both right. It depends on the purpose of the vehicle. If it was the BMW for you, because you're going to be the boss, you want a good car, then it wouldn't matter how busy you are, you're going to get that BMW, it would be a fixed cost. But what if the vehicle we're talking about is a minibus to take your workers to site? Depending on how many different sites you've got, depends on how many vehicles you need. It's a variable cost. So company vehicles could be capital if you buy it. It could be fixed if it's independent of volume, or it could be variable if it's related to volume. There's no one answer here. It depends entirely on your business and how it affects your business. What about advertising? What does that one come under? Variable? Capital? Variable? It depends again on how you're managing the business. You might say, I'm going to spend £5 grand on advertising this year, regardless of how busy I am. It's a fixed cost. Or you may say, the busier we are, the more profits we make, the more we'll spend on advertising. It's a variable cost. You may actually say, the quieter we are, the more we need to spend on advertising. So it's actually inversely variable. So it could be fixed, it could be variable, or it could be inversely variable, depending on your management of the business. And it could also be capital. If you think of Arnold Clark's halogen balloons, they go up every year when he has a sale. They last for years and years and years. And he's spreading the cost of these over a number of years. It's the same with banners around sports grounds. They last for years as well, and you can spread the cost. So advertising could be fixed if you say that's exactly what I'm spending, or it could be variable if you say the more profitable we are, the more we're spending, or it could be inversely variable, the quieter we are, the more we need to spend, or it could be capital. It depends on your business. What's important is you consider all of the likely costs you're going to have. That's where a lot of our startup clients get it wrong. They think we've got a really profitable business, and they forget half the costs. They say, I'm taking on staff, and I'll be spending £12,000 a year paying my staff wages. They forget they've got employers' national insurance to pay on top of that. And that's another 12% onto the wages bill. And there's lots of things that you forget.
Sorry, did you include a small percentage for inflation or like things that you...
Yes, you probably would, if there was evidence that there was inflation. Because some costs don't go up, some do. And again, there'll be research somewhere that somebody says this is what's happening to the prices, this is what inflation is. Because inflation is just a bold figure across the country. It doesn't affect everything. Inflation's gone up by, what was it, 1.9% in the last few months? The price of butter hasn't changed at all. I buy Anchor butter, the price hasn't gone up. So inflation hasn't affected butter. It's not in the shop I go to. So you can't get exact statistics here, but you can get general impressions, which is enough. Okay? So look at your own business, look at all the likely costs you're going to have, and then put them into one of these three categories. And it might be different. The same cost might be fixed to one of you, variable to one of the other ones of you. It may even be capital. As long as you know. What one-off startup costs will you have? One-off costs that are not going to be regularly recurring. Then, what regular costs will you have? And then once you've identified the regular costs, which ones are fixed and which ones are variable? Because as you forecast changes in your sales, the fixed costs won't change. The variable costs will have to be adapted to the changes in volume of sales. Remember to be sure you've considered all the likely costs. it's one of the biggest bugbears for business advisors. You guys come along with great ideas and you forget half the costs and you think you've got a really profitable business idea, and then business advisors say you've forgotten this, you've forgotten that, you've forgotten this, you've underestimated that one, and suddenly your wonderful dream kind of deflates a wee bit. Don't worry about that. Business advisors will catch these things, and they try to keep you happy and buoyant as well. Estimate each of your running costs and what they're going to be each month, because you have to prepare financial forecasts for 24 months, your likely sales each month and your likely cost each month and the likely profit or loss. So again, business advisors will help you here, but try and remember the costs. As a general rule, when you're writing your business plan, when you're writing your story, every sentence you write, stop and say, is there a cost implication in that sentence? And if the answer is yes, find out what that cost is and how much it's likely to be and how frequently it's likely to be. That way you'll pick up most of the costs that are involved. And if you don't, business advisors will help you remember them. The purpose of the bookkeeping that we looked at before the break is to prepare financial statements that allow you to gather information to be able to make business decisions. Profit and loss account, remember what I said before the break, it's based on transaction timing, not on money changing hands. So a profit and loss summarises the trading activity over a period of time. Most businesses prepare annual accounts, because you have to prepare annual accounts for tax authorities. But if you remember, accounting is historical. It's about information from the past, accurate information. And if you only prepare annual accounts, then you only find out how well or how badly you've done at least 12 months after you started. That's not much bloody use to you. Finding out 12 months later, well, things aren't working out the way we thought they might. We recommend you keep monthly accounts for yourself. Every month, prepare a profit and loss account. Have a look and see what were our sales, what were our costs, what was the profit or loss. And if it's not going the way you expected it, you have to investigate it. That's the real purpose of accountancy. You've got bookkeeping, the boring bit, and you've got financial management, which is using the information to make better decisions. And the better your information, and the more frequent you get information, the quicker you can make decisions to change things that are not working. So keep monthly accounts. Profit and loss account summarises the trading activity, the total sales and the total expenditure, ignoring completely whether the money's actually been paid or not. A profit and loss account usually looks like that. The income you're generating from sales, less the variable costs, the costs that are changing with the sales, to leave you a gross profit, and then you've got the fixed costs, and hopefully that will leave you with a net profit. The reason accountants do it that way is these fixed costs are not going to change. And once the gross profit equals the fixed costs, that's you covered all the fixed costs. Beyond that, you're going to start making real profit. So that's called break-even point. When the net profit, the gross profit you make knocks out the fixed costs. Once you cover them, you're then into profit making. So here's a little example we'll look at. This is information. It could be forecasts that we've pulled out of a business plan, or it could actually be historical information. The basic principle is the same. We've got business ABC Joinery. They reckon their sales will be $3,700 a month. Personal wages for the owner, that's £1,000 a month. Direct materials, which is a variable cost, it's changing with volume, £700 a month. The other costs are fixed costs. They're going to be the same each month. Advertising, heating and lighting, motor, blah, blah, blah. All these costs are there. We've also got a vehicle, which was initially bought for £4,000, and we're going to spread the cost over 4 years. So we're depreciating it by £1,000 a year, reducing the value of the vehicle by £1,000 each year, and charging £1,000 as an expense each year. Similarly, a computer for £1,000, we're spreading it over 2 years. And we've got other equipment we're buying, £2,000, it's going to cost us